Welcome to Obsidian Optics, where we dismantle financial narratives and rebuild them with clarity. My name is Graham, and I've spent years obsessed with the mechanics of wealth. Today, we're tackling a deceptively simple question: should you buy real estate or should you rent? This isn't about kitchens or curb appeal, it's about capital allocation, leverage, liquidity, and long-term wealth. We'll move past emotional arguments and give you 10 structural facts to analyze this decision like a financial analyst. By the end, you'll have a system to find the right answer for your unique financial reality. Let's get started. Let's start with leverage, the double-edged sword of real estate. When you buy a $500,000 house, you might put down $100,000 and borrow the rest. You control a large asset with a small amount of your own money. If the house rises 5%, you gain $25,000, a 25% return on your cash. But if it drops 5%, you lose $25,000, also a 25% loss. Leverage magnifies both gains and losses. Renters avoid this risk. Rent is predictable, and market swings don't affect your net worth. The trade-off: renters give up leveraged gains for risk avoidance. So ask yourself, what's your risk tolerance? Don't make this choice lightly. Know what you're betting on and what you're risking. Many people compare their mortgage payment to rent and think they're set. That's a mistake. The mortgage is just the start. Ownership means property taxes, insurance, maintenance, and often HOA fees. Maintenance alone can cost thousands a year. Renters? They pay rent and maybe a small insurance premium. That's it. So don't just compare mortgage to rent. Look at the total cost of ownership. Don't be fooled by simple calculators. Dig deeper. Real estate is a long-term, illiquid asset. Buying with plans to sell in 2 to 3 years is risky. Transaction costs and market swings can wipe out gains. Closing costs and agent commissions can eat up 8% or more of your home's value. Your property must appreciate just to break even. Short-term ownership is a gamble. The longer you hold, the more likely you are to profit. Most experts say plan to stay at least 5 to 7 years. Renting, on the other hand, offers flexibility. Move for a job, travel, or pivot your life without being tied down. Flexibility has real value, especially if your plans are uncertain. Renting isn't throwing money away. It's buying freedom. If you value flexibility, renting may be the smarter financial move. Time horizon is critical. Don't ignore it. Match your housing choice to your life plans. Liquidity, how quickly you can access your money, matters more than most realize. Real estate is illiquid. Your down payment is locked up and hard to access in a pinch. Emergencies or opportunities? You can't sell a bedroom overnight. Renting keeps your capital liquid and available for emergencies or investments. Liquidity is financial agility. It lets you act fast when life changes. A homeowner may be house rich, cash poor, while a renter with liquid assets is more resilient. Owning isn't bad, but know you're trading liquidity for potential appreciation. Ask yourself, how much of your net worth are you comfortable locking away? For many, especially early in their careers, liquidity is a strategic advantage. Don't underestimate the value of having cash on hand. Sometimes flexibility is worth more than bricks and mortar. Every dollar you put into a house is a dollar you can't invest elsewhere. The rent and invest the difference strategy only works if you actually invest the difference. Historically, stocks have outperformed real estate, but behavior matters. Homeowners benefit from forced savings. Mortgage payments build equity automatically. Renters must be disciplined to invest savings consistently. Many aren't, and that's where the plan falls apart. The best strategy is the one you'll stick to. If you need structure, homeownership's forced savings can help. If you're disciplined, renting and investing can build more wealth. Know yourself. Behavioral discipline is as important as math. Opportunity cost is real. Don't ignore it. Choose the path that fits your habits. Inflation and interest rates reshape the BIV's rent equation. A fixed-rate mortgage protects you from rising housing costs. Your payment stays the same as rents and prices rise. Inflation erodes your debt and boosts your home's value. But high interest rates make borrowing expensive and can depress home prices. Timing matters. Buying at low rates can mean overpaying, while high rates may offer better deals if you can refinance later. Renters face rising rents when rates are high, as fewer people can buy. Always analyze the current economic climate, not just the sticker price. The right answer changes with the market. Don't ignore macro forces. They can make or break your decision. Lock in advantages when you can. Stay flexible when you can't. Diversification is the foundation of risk management. Buying a home concentrates your wealth in one asset in one place. If the local market tanks, your net worth takes the hit. Renters can invest in diversified portfolios, thousands of companies, industries, and countries. Home ownership is a concentrated bet. Renting and investing is a diversified one. Both have risks and rewards. If you're confident in your market and want leverage, buying can pay off. If you prefer spreading risk, renting and investing may be safer. Know your risk tolerance. Don't put all your eggs in one basket unless you're prepared for the consequences. Diversification isn't exciting, but it's powerful. Numbers matter, but so do feelings. Home ownership offers stability, pride, and control. Paint the walls, plant a garden, put down roots. For some, this emotional return is worth more than any spreadsheet. Renting offers freedom, no maintenance, no property taxes, no stress over repairs. That mental freedom can be priceless. Assign your own value to these factors. For some, pride of ownership is worth a lower return. For others, the simplicity of renting is worth more than equity. Don't ignore your feelings, integrate them into your decision. The best choice is the one that fits your life. Tax policy can tip the scales. Homeowners may benefit from mortgage interest deductions and capital gains exclusions, but recent tax law changes mean fewer people qualify for these breaks. Selling your primary residence can mean tax-free gains. Stocks don't offer that. Renters get no direct tax benefits, but avoid property tax hikes and policy risks. Tax laws change. Today's advantage may disappear tomorrow. Always model your personal tax situation, but don't count on incentives lasting forever. Home ownership's tax perks are real, but not guaranteed. Factor them in, but don't let them drive your decision. Policy is a moving target. Plan accordingly. After all this, the buy vs rent decision is a cash flow engineering problem. Build a model. Don't rely on gut feelings or simple calculators. Input all variables: purchase price, down payment, interest rate, taxes, insurance, maintenance, HOA fees, rent, and investment returns. Project scenarios over 5, 10, and 30 years. Stress test. What if markets crash? What if rates rise? What if you move? The goal isn't a perfect prediction, but a clear understanding of trade-offs. Data, not emotion, should drive your choice. The right answer is personal and probabilistic, not absolute. Make your decision with eyes wide open. Engineer your financial future. Don't leave it to chance. Confidence comes from clarity. There's no universal answer, only the right answer for you. Renting and buying are tools. Use the one that fits your goals. Rent buys flexibility and liquidity. Buying builds equity and leverage. Diversify risk or concentrate it. Choose consciously. Your decision shapes your financial future for decades. Analyze, model, and commit with clarity. This is OBSIDIAN Optics, where we decode systems so you can decide with confidence, not emotion. Thanks for watching.